Hi everyone, this is Rob Roy and welcome to the Elliott Elite U.S. market update. Well, this week brought us a relief bounce from the heavy selling of the previous week. So obviously the question becomes, where do we go from here? Well, let's take a look at the chart and what Elliott Wave is telling us regarding this move. As you know from all the previous recordings, that we had the long wave 3 accented by a vertical move towards the end of the wave 3, which is quite normally a point where you start to run out of steam because everybody gets piling in thinking that, oh my gosh, I'm going to miss it, I'm going to miss it, let me in, and then you have the lull, and that's what we had, which creates the vacuum below, plus all the sentiment indicators, all the things that we shared with you that set up this move to the downside. So the move to the downside created the wave 4, and we're right at a 53% correction, normal level, right in the range of the historical 50% level, the Fibonacci 50 and 61.8% regions, so a very normal spot to find that relief bounce. So then the question becomes, where do we go from here? Is this bounce over with? So let's use our Fib retracement tool on this relief bounce from the wave 4, and when we see that, very important to note we have rebounded right to the 61.8% Fib retracement level. Let me explain why I say it's so important to see us there. All these Fib levels are resistance points. That's what Fibonacci percentages levels are. They are support and resistance levels. They're designed to give us ideas of when moves might enter a point of resistance or support to help us make decisions with our trading. So the 38.2% is a Fib level, so when we bounce up, we could see some resistance there, and we did. Note, for a couple days we kind of hung around there. Is that it? Is that all the bounce we're going to get? Well, then we moved up to 50%, and we closed right there on Wednesday. Again, very normal to see a resistance level right on one of these Fib levels. So we broke that level and we made it up to 61.8, and that's how these Fibonacci levels work. Once you break one level, highly likely that you're going to the next level, and that's what you use in your decision making. So we're right here at the 61.8%, which in my opinion is the strongest of all Fibonacci levels. And the fact that we're there now, we don't have to at 38.2% say, okay, I wonder if we're going to 50, or I wonder if we're going to 61.8. Now we're at the strongest level. So the trading decisions become quite easy at this point in time, because the two things that could happen from here are, one, if we go up, if we break this level and go up and hit 71.8%, after 71.8%, 6%, you tried to say, we're very highly likely going to test the recent highs. Or this could be the end of it. Maybe we have a little bit of resistance here and then fall down and test the lows. But these V bottoms, and I'll show you what I mean by a V bottom. So we had this pretty vertical move to the downside, followed by a pretty vertical move right back up. See how that creates a V? History tells us that V bottoms rarely hold, meaning that it would be surprising for the market to go up, break the wave 3, head all the way up and hit that wave 5 target without at least testing this low. And the testing process of lows works one of three ways. And you're going to laugh at this and say, well, duh, but it actually does matter with the testing process. So let me go ahead and take the Fib levels off, and I'm going to take this line off, and then I'll explain to you what I mean by the testing process. So let's assume and note that we do have a doji here. It's what's called a tombstone doji. When you open, trade much higher throughout the day, but then you come back down and you close right at the open, which was near the low of the day. That's not a bullish thing, but we're moving into a holiday weekend. Monday is President's Day in the U.S. and the markets are closed. We used to have Washington's birthday, Lincoln's birthday, etc., etc. The kids were out of school for all those, so they just combine them all into one, and they call it President's Day, and it's a holiday for the markets. So Friday was moving into a long weekend, so you can understand why people were pretty skittish to stay long on any of these bounce plays that they might have had coming off of the lows. So that doji is a little surprising, but not super surprising, but something that we certainly need to keep an eye on. All right, so we're right here, and if we have a testing process, meaning that we come back to test those lows, the testing can happen one of three ways. You get a move lower that stops just short of where the low was from before, and then you rebound back to the upside. That one kind of catches people off guard because the expectation is for a complete test. In other words, most people think that when you test the low, you actually test the low, that we come all the way down right to the same low that we had, and then we have our relief move. The one that, believe it or not, lasts most often is when you have the testing process, and I did actually a whole webinar on this once, is when you actually come down and you break those lows. In other words, we may have a print way down here that breaks this previous low right here. So we come all the way down to this low. That scares everybody because everybody's like, now we're going on a new leg lower. This isn't a test of the lows. We're actually starting a new leg lower. Everybody panics and the smart money comes in and boom, then you get your big move to the upside, which creates your wave 5. So one of those three things could very well happen due to the fact that we are on the 61.8% fib level. But again, if we move higher, if we rebound all the way up to 78.6, then we're probably testing the highs from before, and we'll see if we ever get a testing of the low. Nothing is 100%. I said V-bottoms rarely hold, but rarely doesn't mean never. There's no such thing as never. But there's an awful lot of dojis on the chart. There's a lot of indecision getting ready to start this next week. All the FANG stocks, as they call them, where you have Facebook, Apple, Amazon, Netflix, and Google with the acronym FAANG or FANG. They are all showing, and they've been the market leaders throughout this entire move, are all showing dojis and at resistance levels themselves. Let's take a look at the SPY so we can bring volume into the mix here. And what we can tell from the volume here is that we did have a high volume doji, so that tombstone doji that occurred on Friday was on above average volume. Note the volume was lower down here on the relief bounce, so the volume dropped off. And that's not unusual. You know, people get a bit nervous and skittish, and all the people that run for the exits here aren't so apt to want to turn around and jump back in because they got burned on that way down trying to catch the bounce that occurred right here. So we had some pretty good volume on that bounce day, and that's where everybody's like, all right, buy the dip, buy the dip. And then we went down and broke that, and those people got hurt. So then on the next bounce, they're a little more reluctant to jump back in and try to take their position. So the volume is telling exactly what you would think is going on with this pattern that we have. Looking at our sentiment indicators, looking at the VIX, we were back down, closed just under 20. We had two closes right about the same spot there on Thursday and Friday. I would be very surprised if we go down to these old support levels around 9. I'm going to condense the chart, which is a really cool feature that you can do with your profit source and integrated investor. Again, in my opinion, the best trading tool that exists out there, and by far the best with Elliott Wave, and you know that that's my single favorite technical indicator. So let's take a look at potential support levels on the VIX. It could be anywhere from where I've drawn it now, about 16, 17, all the way down here to around 15. And my point is, what was resistance here on the previous range, where that 9, 10 level was the low, and we would bounce up when we'd hit that 15 level and we came back down, see that each time? That's likely going to be a support level. Old support becomes new resistance, or old resistance becomes new support. Those are, again, old cliche type statements, but the reason that they're old and still around is because they hold water, they work. People don't tend to cite things that historically haven't worked. They cite things that historically have worked. So that would be where I would kind of look for a little bit of support. It can be anywhere higher from here, but we'll see how the beginning of the week trades. Perhaps we try to break above that 61.8% in the beginning of the day, but the interesting thing is going to be that other world markets are going to be open on Monday. It's just the U.S. that's closed, and we'll have to see what happens around the world, which very well could be telling for our own market open. Taking a look at TNX. I also wanted to bring another indicator in here, the DMI, because again, if I was forced to just pick one indicator, it'd be Elliott Wave, but when you're creating a trading system, you like to have supporting indicators. And to me, the best supporting indicator for Elliott Wave is the DMI. And what is that telling us? I'm bringing up the chart of the TNX, and the TNX is, as you know, interest rates. We've introduced that, and interest rates have been on a tear on their own wave 3. And then the question becomes, are we starting this? Note a doji here as well on Friday. It's just doji day Friday. Everything's making a doji, it seemed like. It just shows you how much indecision there is in the market right now. So with this doji here, does that mean we're starting this wave 4? Remember, this wave 4 does not tell you, yes, the wave 4 is starting now. It tells you if it started now, that's the likely target. And a big difference there. People misunderstand that. But maybe we are, and we'll just have to wait and see. But that's always the trickiest thing on a wave 3. We can trade the wave 3. We've talked about that. We're going to talk about that in the future, because why not trade the strongest of all the waves? But the tricky part is, when is it going to end? And so when we look at the DMI, that can help us. Now, what it's telling us, this black line is the ADX. Just think that indicates strength. The green line is the positive directional indicator that indicates buying pressure, and the red line indicates indicates selling pressure. So think of this as upside and downside. So green is up, red is down, black is strength of the move. It's not picking direction. It's telling you the strength of the move the ADX is. Now that the ADX has broken above the green line, which would represent an upward move, which is what we had, that tells you the strongest part of the move is over. Does that mean that the wave 4 starts now? No, it doesn't. It tells you the strongest part of the move is over. Could interest rates go higher just with less strength? Absolutely. Or, because it's telling you the strongest part of the move is over, we could start the wave 4. So that's a warning sign. So if you had been long interest rates, this would be telling you right now, either lighten up your positions, take them off, or protect them, but don't just stay purely long that interest rates are going higher. That's what the DMI is telling you. So we've got a wave 3, a strong move that was confirmed by the DMI, and now the DMI telling you we're still in a wave 3 right now, but hey, be careful, the strongest part of that wave 3 is over, so be prudent with your trading decisions and act accordingly. Last thing on the sentiment indicators, and I'll wrap this recording up. You're probably wondering, we talked about the VIX, but what about the bulls versus bears survey? And the interesting thing is the bulls have come down quite a bit, as you'd expect, but they're down at 52, and 55 was the number that's normally considered high. We just went up to 65, which was insanely high. But interestingly enough, the bears haven't moved much. They haven't come up much. They're still just under 15. So there's still some people that aren't as bullish as there once was, but again, that was wildly extreme. But there's still not very many people that are actually bearish. So my point is, a few less bulls, but not really any more bears, which does leave ammunition then, from a sentiment standpoint, that we could have that test of the wave 4 lows on the SPX pattern. So anyway, lots of interesting things to talk about in the market, and certainly next week is going to be really interesting to see where we do go from here, because we're at such an important Elliott wave Fibonacci point in the market. So hope you've had a wonderful weekend, and we'll be back to talk to you again next week. Take care, everybody.